In the month of September, it was the best September in the last 15 years. So your S&P up over 3%, your Nasdaq up over 6%, your Dow Jones up about 2.5%, and your Russell 2000 up over 3.5% as well. Usually, as I mentioned last month, September is really the only historical month that has an average that is down in relation to all the other months throughout the year. Well, this September, stocks stay hot. As there's a couple things to note. One would be the Fed interest rate cut that happened, and it was the expected 0.25% cut. And there are a couple things that could have happened here. It could have been even a 50% cut, which sounds good when we're lowering rates. Usually when rates lower, right, that makes bonds and interest rates come down, which makes bonds, treasury, those sorts of things a less desirable asset, which means people look to more risk on assets or elsewhere. But because that would have, that 50% rate cut might have been outside of what was expected, it may have caused, some chaos. But the fact of the matter is we got our quarter point cut, and we're looking forward to it. The market is pricing in still about a 1% cut over the next year. Now, this is really important to note, and just stop here to look at what do we need to do? What do we want to do? So first and foremost, as rates come down, again, risk assets will start to be more desirable. So think of that money market that you've been at 4%, or last year it was 5%. As that continues down, more likely than not, the large amount that is in treasuries, which is like $7.7 trillion, it will find a new home. Now, that doesn't mean it's all going to go into the market, but it's going to find a different home because it's less desirable. Now, that's number one. Number two, it does say it's a good time to get an individual bond that might still be, elevated because we're expecting rates to lower. So individual bonds, funds, and life and annuity products, which are primarily based off of interest rates, are better buys now. Again, so if we're looking forward and we're expecting that drop down, that'd be a good thing to do. Now, as we look at the stock market, things are still up and to the right. All of our indexes are up on the month, are up on the year. Again, gold's up again this year, silver's up again this year, Bitcoin and Ethereum, which we've talked about plenty this year, are both up. Now, Ethereum did lose a little bit in the month of September, but it's about the lone wolf when it comes to that. Other big news in the equity world is NVDA is doing $100 billion deal with OpenAI. There's a lot of news on this. Again, it shows to a lot of green there. And, I do also want to highlight the massive increase in silver. So silver is catching up to it's lagged behind gold for the last couple of years. It has a significant increase for this year. So as we take all this together and look at the rest of the year, as interest rates come down, so that is bullish for the stock market. And it's one of the reasons where we haven't quite taken some of our gains yet. We think that there's still room to run. Again, from interest rates going down, the money markets, there's such a large amount there. There's still good news on the AI side. There's still, and most of that good news is still overweight to the Mag 7 stocks, to the what are called hyper funders that are just plowing money into chips and more data centers and all these sorts of things. It's still primarily benefiting them. In September, we saw a little bit spread out to smaller companies, but most of the good news has still happened there. So this firm believes that we still have room to run. We really want to go about it cautious. So as we head towards the end of the year, we might start peeling off a little bit of gains, especially, again, we've had some stocks that have run up, over 80%. We've had some significant gains in some of our holdings. And so we may start to take a couple of wins off the table, not selling out entirely, but just take a couple of chips off the table as this year progresses into next year. It seems to us that there is still foundation for the market to continue upwards. Now, as always, the market is a fickle thing. It can drop on a dime. And as we're looking at interest rates going back down, we want to caution you from a personal and then a professional standpoint. So from a personal standpoint, just because there are cheaper interest rates does not mean that you should chase those cheaper interest rates. Now, there are some smart things to do. So if you've purchased a house in the last couple of years and you are at a 6 or 7 rate, and now, if it's a long-term house and you're looking at closer to a 5% rate, well, maybe you refinance there. It's fairly easy to run an analysis on the long-term benefit of that. Short-term, not better. And that's a really important part. So there are it is good to take advantage of the lower interest rates. But the caution here is that we don't treat it like free money as we go about our everyday expenses. And that's going to be a tricky thing to deal with as we still deal with extremely sticky inflation. So that's our caution there. As we look at interest rates as a whole, again, we're coming from, while undesirable for houses and for other things, where interest rates are at right now is a fairly healthy place for the economy. It doesn't allow companies that should not be around to stay around. And if we get back down to the 3% range, our interest rates go back down, well, that allows for zombie companies. That allows for wild valuation. That allows for a lot of confusion in an already chaotic world. So that's our caution. As I mentioned, we are still optimistic. We are still bullish. And again, especially if we look at being a long-term investor. Are we worried about what the next couple of years are going to look like when we've got 30 years, 40 years in our time perspective? No, we're really not. But we want to be mindful of what's on the horizon. We want to start to, again, not go crazy right now, knowing that we are already overvalued, and there's a very good chance that we will continue to be overvalued. So we can participate in that. We're not gonna make any drastic changes, but again, we remain cautiously optimistic at this time. Well, that's it for this month. Thank you guys so much for watching, and I'll see you in October.